Good morning, traders. Thanks for joining me today here on Monday. It is 8:02 a.m. Chicago time on the 12th of December, 2022. This is episode number 2375. 2375. Derivatives trading is not suitable for all investors. Past performance is not necessarily indicative of future results. A quick reminder, first and foremost, as I've posted across Twitter and Convergent Trading's chat rooms and stuff, it is rollover today. We are trading and quoting March of 2023. So ESH3 or NQH3 or RTYH3 or YMH3. We are no longer quoting the December contract. You really should be trading the front month. Don't hold off on the back month. It gets thinner. It gets a little bit more difficult to read. The other notice I'm going to give you is that because it's rollover and it's triple witching Friday, this Friday, it's expiration Friday. For those of you who don't know, triple witching is the expiration of the futures. The options on the futures and options on equities. This is the major monthly expiration and quarterly expiration. I'm not talking about weeklies or zero DTE options or anything like that. So this week, the volume is going to be hard to read, and so will the delta. So an early warning here: until much of the roll is done, the delta is not something that is usable. So that's that. Let's dive right into what we've got here today. Looks like my camera is still choppy. It's kind of annoying because I keep resetting the settings on it and it just refuses to hold those settings. So mixed posture this morning in the S&P. We've got a market that has got a double distribution, a very clear double distribution. It's traded below the settlement and now is above settlement across the board. So we have a mixed market, and there's nothing major pre-market on the calendar for earnings. And after the close today, we get Oracle. Oracle is quite sizable. $12 billion in estimated revenue expected at $1.18 per share. Look out for that. This week is going to be governed by the fact that we have CPI tomorrow, and we have the Fed decision on Wednesday. So for the week, the key figures are: we have the ZOO number out of Germany, then we get the inflation rate tomorrow at 8:30 Eastern, core inflation. Inflation is expected at 7.3%, the prior 7.7. Core inflation expected at 6.1%, prior 6.3. So any variance from that is going to be quite dramatic. So those are the key figures. Then we get the inflation rate out of Great Britain on Wednesday early on. Then we get the Fed rate decision. Remember, the Fed is in a blackout period still ahead of the FOMC decision. And then we'll get the FOMC decision at 2 p.m. on Wednesday. Then we get the Fed's press conference at 2:30. And then industrial production from China on Wednesday night. Thursday, we get the BOE interest rate decision, the Bank of England, as well as the ECB's rate decision. So tons and tons and tons for the market to reprice this week. And in addition to that, layer on top of it the fact that we have rollover and expiration this week. So it's just going to be pardon the term, hopefully no kids are around, it's going to be a shit show this week in terms of valuations and price discovery. So be prepared for that. Retail sales out of the U.S. on Thursday morning, GFK consumer confidence on Thursday evening, and then Friday we wrap up with retail sales and, of course, triple witching and an expiration. So that's what's on deck. There's a lot there. Just be ready for it. Today, what do we have left here? We have the consumer inflation expectations. This is a single tier number, but because it has to do with inflation, I don't know what the response will be. And then we have COVID cases continue to increase in China, and they don't have nearly the hospital beds they need for the population that they have, and that's to be watched closely. GDP out of Great Britain came in at 0.5, better than the expected 0.4%. The prior is negative 0.6. Pretty good news there. And then Amgen is buying Horizon Healthcare or something like that for $26.7 billion. That was announced today. They're not changing their guidance. And then Microsoft is buying a 4% stake in the London Stock Exchange. So it's interesting because Google is partnering with CME on cloud services. And now you have Microsoft, which has its own Azure service, partnering with the London Stock Exchange. So you get these big mega tech companies moving into the financial services sector. So that's that. The S&P, as I said, is a multi-distribution profile. And with about 27.5 points of range. The inventory overnight is 7% to the short side, pretty much even. And the volume's 134,000. Now, the volume should be a lot higher. It should be a combined volume, 134,000. It's relatively low, with the range being relatively low. The point of control remaining where it was last Friday. Remember, the S&P premium is 32 points. 32 points for the premium in the S&P. So whatever price you see in front of you in the S&P on my charts, if you want to look at it in the December contract, you need to subtract 32 points. While I'm at it, remember the rotations are updated every Sunday night. And you can see there the S&P rotations remain the same. NASDAQs have fallen to 24.5. The Russell 3.8. The Dow 48. And the crude, the rotations have increased given the big moves we had last week. So the next thing I want to look at here is what was expected last week as we this is Z2. Okay, so this chart here is from Friday and it represents Z2. So we need to add 32 points to these prices to get an equivalent of what we see today. And Friday's plan, key plan, Friday's key plan is a push towards the 39.65 settlement, which would put it at 39.97 or so, 39.98 really for the settlement, for the prior settle. So the main idea behind Friday was a push, a gap to settle up, push towards that that prior high, and then for it to drop to test the 30, which is now the 50. And that's the key plan for Friday. What did we actually do on Friday? Here's what we actually did. This chart now is in H3. This is in December. As you can see here, ESH3. This is represented in December. So again, you need to subtract 32 points to get the December valuation. By the way, several of you have written on Twitter saying, what the heck, 32 points for an adjustment premium between contracts? That's insane. 32 points. And it makes sense because of the magnitude of the price we're at, because of the high interest rates that are being carried by the underlying contract. Remember, the S&P is built on the SPX. The SPX has dividends and interest to expiration, and that interest is now really high. Dividends are already pretty high. Companies are paying pretty high dividends now. So the difference between the last contract, which is expiring. Remember, an expiring contract on Friday, the December future contract will equal the cash. So on Friday, on expiration, the December contract should equal the SPX. It should have no premium left in it. So the March contract has a high premium because by the time the March expiration comes along, the March contract has to meet the price of the SPX. And the only way you can do that is if it accounts in the futures the value of dividends and interest. That's Futures 101. That's an explanation of what is called the cost of carry or the carry interest. And currently it's extremely high. It's extremely high. And so we have this 32-point difference. And last time, the last roll in September, because interest rates were already higher, it was like 18 points. The one before that in June, the roll in June, had negative 1.5 points in negative 1.5 points in carry interest. In other words, the interest rate's so low versus the dividends that it is actually negative, and now it's hugely positive. So that's a lesson for you, for those of you who are new to futures and don't understand why there's such a big disparity. If your data does not adjust for that gap, does not take the past contracts and add 32 points to them, you have a 32-point gap that doesn't truly exist. I know it's complicated, but that's just the way it is. So that's where we stand. So we opened on Friday right where we were in the trader bite, and guess what? We pushed right up and nailed that gap to settle, GTS, gap to settle trade early on. Chop, 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 chop. We made a further advance into what is now the 40-10, which was, just subtract 30 points, 40-80, 39.80. And then what did we do? Boom, just sold off. So that's exactly as what was expected before the open. We expected the market to respond higher to settlement and then roll over and drop. And that's what we got. So we've been kind of trying to walk up on the daily. We're trying to walk up, and then on Friday we ended up breaking the one-time framing higher. Remember, we put in this low, higher low, higher low, and then we broke that on Friday. And now we are trading right in here with the mass of balance. Now this is all adjusted. My data is all back adjusted by 32 points. So all of the prices have gone up 32 points on my charts here, and you can see balance remains above us. I still see this as an impulse down. Let me turn down my news feed here. I still see this as an impulse down. I still see this as a pullback. I was expecting the pullback to go as far as this low right here, 40.19, which puts us at 49.90, 39.90 in the old contract. And by tomorrow, I just want to stop referring to December contract. I'm doing too much math as I'm talking. But it can go back. I'm expecting it to go back as far as that before it rolls over. I'm expecting this low to be taken out. This is an impulse low that is yet untested. And on Friday, attempted that test. And what we did on Friday is we finished in a neutral extreme down. What does that mean? We put in the first hour's high and low. That's called the initial balance. And in general, once we put in the initial balance, there's a historical probability of approximately 70% to 70, yes, about 70% that once the high or the low is put in, if the high or the low is breached, then the other high, the opposite high or low, the first hour is not, by a historical probability of 70%. Remember, past performance is not always indicative of future results. So this is what we would call normal or normal variation day. If we take out the high and the low, that's called a neutral day. The probability of that somewhere around 30%. Okay, that's the other side of the 70%. If we take out the high and then take out the low, giving a neutral day, and then we finish at the extreme, at the lower quartile of the range, that's called neutral extreme. And if it happens to the downside, it's called neutral extreme down. And this is typically a reversal type day. Why am I going into so much detail? I'm here to tell you that as long as it holds this 39.90 area, we're expecting it to go down on a either today or the next few days. As long as it just holds at 39.90, we are likely to see the low of this impulse day down. Okay, so that's what we're looking for. We're looking for it to go down and test that 39.50 area. Remember, the old number was 39.14, so it'll be 39.46 now. So we missed it by a couple of points last time, and I'm still looking for this 39.46 area test. Okay, and this is not something I'm inventing. I'm just telling you what price is saying, and what price is saying is we're likely to get down there as long as we hold this strong area of balance up here. And it can actually move a little bit higher as long as it doesn't breach the 50% of this entire swing. We still have a pretty good chance at the low, but that's what I'm looking for. That's the key thing that I'm looking for. So if we get some selling, if we push up and we get some real selling, like an impulse down and a clear break from the 2-day balance, Friday, Thursday to the downside, then I need to remember the reason I'm telling you the 39.46 is so you can be a strong trader and hold for that test of the old low, at least at whatever it is, 50. I don't know what it is in the new contract, 53, I guess. So that's important. Once we get a hold of that short and it starts to break below, you want to look for that 39.53, 39.46 in the March 2023 contract. Have I lost you in all of this detail? There's just a pretty good structure currently. Here's how it looks on a composite. But guess what? I'm going to put these composite charts profiles together just to see where we are in this 3 days of balance that we've had, which we've been inside of this multi-day balance from the middle of November. Where are we now? We are right here. And again, we're looking for that 39.90-95 area to hold. 39.95 area to hold. This is what auction trading is. This is how big traders look at the market. In my opinion, in my experience, you kind of look for what the big picture is, and then you try to locate your trade within a smaller segment by going to smaller time frame charts. So in my head, 39.90, 95, that zone, key. As long as we stay below it, I'm going to be very tentative on the long side, pretty strong on the short side. So I'm going to look to my shorter term charts, my trigger charts, or whatever, order flow and things like that, to try to locate or recognize, not locate, because I'm not out hunting for trades. I'm waiting for trades to come to me. I'm waiting for trades to set up to give me an advantage on the short side. So now I know that I need to be short somewhere against that area. And I don't want to miss a big short breakdown. If the market breaks to the downside, I'm going to be looking aggressively at shorting pullbacks. And I'm going to be targeting that 39.52 and then 46 below. So here's where we are versus the last 3 days of balance. Now I'm going to take this whole thing and ram it right into the composite. Why? Because it is part of the composite. We have been in balance for quite some time, and that number is 91.5 on the TPOs on a market profile chart. So again, 90, 95, more confirmation of 90, 95. We need to watch this area. If it gets up here and starts moving up and down, up and down, up and down, you're going to get chopped to pieces in this area trying to get a short on. It needs to go up, come back, and then have a hard time going up again, and then start to move lower for us to trigger the short looking down, looking into the 39.52 area. This is the most important thing about the S&P now. If we get above 90.95, then we have a hard time pulling back and we start to extend higher. Then it's a short squeeze. Then we're looking to push into 40.50, 40.60 up here in this zone right up here, okay, into the next low volume node. Okay, so that's that. You know, I would normally look at relative delta at this point and tell you, okay, delta is chasing small lots and blah, 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 blah. But guess what? It is rollover, and the volume is going to be contaminated today. And from tomorrow onwards, I'll post the pace of roll so we can see how much of the roll has completed. And if the roll completes 95% or better, which is expected by Wednesday, we can go back to using order flow as a major trigger tool to trade. Today and tomorrow, we don't want to rely on order flow because it's contaminated by calendar spreads as people move large positions, work large positions from the December into the March contract, and that's going to show up on the tape and it's going to look skewed, okay? I'll leave you with that. I know that's a lot to digest. Here's the intraday chart, the big picture. So there's the impulse, boom. There's the pullback, boom. And then we're looking for, it tried to continue overnight. We're looking for the continuation, still jonesing for that continuation down into the 46 level and below that 39.32 or so. Okay, cool. All right, remember, you're supposed to be trading March 2023. You're supposed to be rolling your contracts forward, your futures forward. Since the old contract's expiring this week, you do not want to be on it. Good luck, and hopefully you gain something today. There's a lot going on Wednesday. Wednesday, we have a futures radio show with Anthony Crudelli, and Andreas is going to be on with a mystery guest. Not even Andreas knows who it is. We're going to have a mystery guest, and we're going to talk about the FOMC. The FOMC is on Wednesday afternoon. And then Wednesday evening, we're doing our Convergent Trading fireside chat at 7 p.m. for about 2 hours. We're going to have several people on. We're going to talk about trading. You can take questions and so on. That'll be Wednesday evening. So I'll give you the links to that. You don't need to register for anything. It's going to be on YouTube. It's going to be live streaming. Very little for you to do. Of course, there will be a giveaway for the Futures Radio Show, and I hope you can participate. Good luck. I know there's a lot going on, and then I'm gone next week for a vacation, 5-day vacation down in Mexico, and then we'll be back for the last week of the year. Good luck. Cheers.